delighted to have Mr. Cohn here to speak to us today. He's a 40-year veteran of the Federal Reserve System, the Vice Chairman of the Federal Reserve from 2006-2010, key advisor to Mr. Bernanke during the crisis, recently appointed by the UK government and the Bank of England to be on the Interim Financial Policy Committee. And he is currently a senior fellow at Brookings, just down the street.
Right.
We're really excited to have you.
I'm glad to be here, and thank you for inviting me. Thanks to John Lipsky, who didn't show up today, for being behind this. So it was great to make the long trip down Mass Avenue from 1775 to 1717. It's nice. I will talk about the committee that I'm on at the Bank of England is a Macroprudential Policy Committee, so I do have an interest there. And I'll talk about macroprudential regulation today. And I have an outline here. I don't know, it'll take maybe half an hour, but what I'd like to do is talk a little bit, a brief definition first, so we're all on the same page. Talk a little bit about the origins or why it's become such a big deal right now, what's happened during the crisis to make it such a big deal. Then a fuller definition of what it is and what people are trying to do, and then talk about some of the challenges of implementing and making macroprudential policy work. So let's see where we are, and then I'd be happy to take questions for as long as you have them afterwards. And I am fighting a cold, so I appreciate for the rough. I apologize for the roughness of the voice, etc. All right, a brief definition of macroprudential regulation. Macroprudential regulation uses microprudential tools, supervisory tools, to try and limit the systemic risk in the financial system, the overall risk in the financial system. So the key differential here is macroprudential and microprudential. So the microprudential regulators, the supervisors at the Federal Reserve Bank of New York, as a couple of our colleagues here are going to be beginning next year, look at each individual institution and try and make sure it's safe. The macroprudential regulators look at the whole system and look for interactions, building imbalances, and things that would make the whole system unsafe and would cause problems in the financial system that would then feed back on the economy. The obvious example is the last 4 years, right? So let's talk a little bit about the origins and what happened in the crisis that brought this to such prominence currently. And one thing to keep in mind, keep in the back of your minds, is there are elements of macroprudential, this overall systemic risk evaluation, that have been present for some time in various supervisory and regulatory regimes. The emerging market economies have been using macroprudential regulation in various forms for a while, and in particular, in part because their economies flow much more through the commercial banking system. Their capital markets aren't as well developed as they are in more developed countries. They're able to exert control over the financial system by regulating the commercial banking system more closely than we could over the whole financial system. So they've been using macroprudential tools, and a good example of that are loan-to-value ratios in mortgages. So when the Hong Kong authorities get worried about what's happening to property prices in Hong Kong and what the risk is in terms of banks lending in Hong Kong, they tend to lower the loan-to-value ratio. So before you were lending at 90%, you could lend at 90% of the value of the property. Now you can only lend at 80% of the value of the property. This hopefully has two effects. One is the lenders are better protected against the eventual decline in the value of the property if they think there's a bubble. And secondly, they hope that by making it credit a little tougher to get, they might even shave the top of the bubble off, and we'll come back to those things again. Even in the U.S., earlier, there was more macroprudential regulation. Someone reminded me of this the other day. There's a paper being written at the board, Federal Reserve Board here, and with one of my colleagues at Brookings cooperating, and the Treasury, that reminded me that there are a number of things that the Federal Reserve Board did over the years, particularly in earlier years, that could fit into this. And think about, I think a great example is margin requirements in stock markets. So in the 1930s, one of the ideas about how did that stock market bubble get so high in 1929, and then why it caused so much trouble when it crashed in 1929 and 1930 and 31 and caused all those bank failures, was the amount of credit that was being given to people buying shares on margin. So in the 30s, I don't know what year, but one of the New Deal reforms was to give the Federal Reserve Board the authority to regulate the amount of lending that could be done against equity, and so-called margin requirements. And the Federal Reserve Board would raise and lower those depending on what they thought was going on, whether the stock market was getting overheated or it was too low, whether they thought lenders were being extended or not, overextended or not. The last time that was used, however, was 1974 or 5. And it fell into disuse, and fortunately the board left it at 50% because I could never remember whether the regulation was for what you could borrow or what you had to put up for cash. But at 50-50, you didn't have to remember that. And fell into disuse because it was the feeling that the developments of other markets like futures markets and options markets meant that you really couldn't effectively control the amount of leverage in the stock market anymore. There are too many ways around it. And there are a lot of studies by financial economists suggesting that markets were relatively efficient in the sense of at least reflected, that doesn't mean they were accurate all the time, but reflected all the knowledge and information people had, and that implied that whether you can borrow or lend doesn't really affect those prices. Those prices ought to price in all that information anyhow. So the board stopped using margin requirements in the mid-'70s, but it's a good example of where things used to be. And I think when that was stopped using that, and there were other examples of credit controls in 1980, President Carter put on controls on the use of consumer and business credit and bank lending. Had a very sharp effect. The economy, which was going into recession, fell sharply into recession when they did that. People stopped using credit. Then they were taken off 3 months later. And I think the fact that that didn't work very well was one of the things that put credit controls and that form of macroprudential regulation into disuse. But in the crisis, it's come, since the financial crisis, come into much greater usage. Leading up to the crisis, there was a very broad increase in leverage and maturity transformation within the financial sector. So lending by banks, but also by non-banks, come to that in a second, increased very rapidly relative to their level of capital. Leverage went up considerably. There also the maturity transformation. There was much more borrowing short and lending long that was going on into the crisis. And that meant when asset prices began to fall, people began to pull back, loans began to go bad, the banking system was at graver risk. There was much less capital cushion to absorb those losses. And also when those markets they were funding in, the short-term markets they were funding in to hold the long-term assets, when those became less liquid, that was a drastic difficult situation. They couldn't fund the loans anymore. Then the Federal Reserve had to open the discount window for them so they could fund it that way. And it went beyond the banking sector into the so-called shadow banking sector. So a lot of mortgages were held in off-balance sheet entities, sometimes sponsored by the banks, sometimes not, that were then borrowing in short-term markets. So again, it wasn't necessarily in the books of the bank, but you were funding mortgages, and in particular subprime mortgages, low-quality mortgages, with commercial paper, asset-backed commercial paper, for example. And as soon as the commercial paper buyers, the money market funds, for example, became worried about what was the quality of loans behind the assets behind asset-backed commercial paper. That whole system started to collapse, and that fed the downward spiral, which then fed back on the economy. The banks weren't only lending to each other in the financial sector, they were lending to, as the mortgage example makes clear, they are lending to households and businesses. So there was a huge increase of credit to the non-financial sector, and especially to households in the mortgage market. The banks were competing very hard, and non-banks, these off-balance sheet entities, competing very hard to make loans. Credit standards were reduced. Risk spreads came in. Asset prices, housing prices overshot equilibrium by quite a bit. And so the analysis was that even though you might look at an individual institution and say, yeah, leverage is higher, but this is a very profitable bank, and they've been able to accumulate a lot of capital in the last few years, and they meet all our standards for being well capitalized. What the authorities and what the private sector didn't take account of was everybody was doing the same thing. They were borrowing short to lending long in the mortgage market against questionable collateral. This got very difficult to trace because, of course, all this stuff was securitized and re-securitized and tranched, and so people didn't know what they were really lending against. They took the word of the credit rating agencies, and the credit rating agencies did a very poor job evaluating the mortgages. So you build a very fragile structure that collapsed and brought the economy down with it, not only the housing market, but the rest of the market as well. Risk was not one of the things one heard in the early to mid 2000s was, well, it's okay because with all this securitization, risk is dispersed around the system, and no one entity is so important that if this housing market collapses, it'll bring the system down because everybody has diversified their risk. It's not in any one place, and that turned out to be not true. So it turned out there were certain hubs within the system that had a lot of risk in them. AIG is a great example. AIG was selling insurance to others who were holding these things. And I don't think anybody realized how important AIG was in the interconnection of other financial institutions. So when it started to go, it looked like it would bring down a lot of other people with it. Another example, a similar example, are the monolines. So it wasn't only AIG insuring mortgages, but there were a couple of mortgage companies that were doing a lot of mortgage insurance. And of course, when the house prices started to go and the loans went bad, those insurance companies went bad, and that meant all the banks and other lenders were at risk as well. Another thing we found during the crisis was that some institutions were too big to fail. The concern was if they failed, the connections, like I talked about in AIG, or just the sheer size of them, Citi and some of the others, that would bring down a lot of the people who had extended credit to them, and you would have more panic and a worse financial crisis. It's very important to evaluate this too big to fail issue, and we can come back to it in the question period, in the context of what's going on. So you have a situation in the early 90s when Drexel Burnham went belly up, and there was a hiccup in the markets, right? No one, the junk bond market took a hit, but the economy didn't. And then you had Lehman, which went belly up and brought a lot of the system down. And I think one difference is the circumstances. So when Drexel Burnham went, the economy was a little weak, but it wasn't as weak as it was. It wasn't suffering from the housing bubble. When Lehman went, it crystallized everybody's concerns about a lot of other folks and knock-on effects there. You had a situation in the 2000s when monetary policy, the Federal Reserve, the Bank of England, other places, was focused on price stability and macroeconomic stability, not financial stability. So our job, according to the Federal Reserve Act, is maximum employment and stable prices. And we were focused on those two things, and didn't really, we thought about financial stability. We had briefings from staff every 6 months on threats to financial stability, but we didn't think that using monetary policy was the right way to attack these threats. There was a debate between clean versus lean. So Alan Greenspan and Don Cohn were in the camp of, we've been through a bunch of crises and we can just clean up after the crisis. We'll just ease monetary policy and don't worry. And if you tried leaning against these asset bubbles, you're bound to make a lot of mistakes. There'll be a lot of false positives. You'll keep the economy under restraint that it doesn't need to be kept under restraint. You're likely to lean at the wrong time and make the eventual bust even worse. So that was the clean part was monetary policy to stay focused on price stability and worry about the detritus from the blow up later. The lean part was what the ECB claimed it was doing. That is, it was saying we're taking account of emerging credit issues and asset in our monetary policy and leaning against an emerging asset bubble. They said it. I always wondered whether you could actually show it in a model that they actually took account of this, but that was certainly what they talked about. I think another issue stemming from the monetary policy situation was monetary policy was pretty darn successful from the Volcker anti-inflation era up through 2007. We went through more than 2 decades with 2 very shallow recessions. There were jobless recoveries and people were a little unhappy, but these were not big recessions. The recessions got further apart. There was a lot of people writing articles about how the economy was inherently more stable, businesses managed inventories better, risk was dispersed, and giving some credit to better management of monetary policy, the focus on price stability being an important part of that. I think that and that was called the Great Moderation. And I think that led to a lot of complacency in the private sector, but also in the regulatory sector and the supervisory sector. Things would take care of themselves, would never be that bad that we couldn't clean up afterwards. And that led to what's sometimes now called a so-called Minsky Moment. Hyman Minsky was an economist at Washington University in St. Louis, and he had a hypothesis that just what I described is what happens. Things go well, people get complacent, leverage builds up, and then people wake up one morning and say, wait a second, those houses really weren't worth what I thought they were when I lent 95% against them or 100%. And you have a scramble for liquidity and a scramble for capital, and that accentuates the downside. So you look at the end of 2007 or the end of 2008 as kind of a Minsky moment. So this led to thinking that there was a missing tool. So you had Macroprudential Regulation looking at the individual institutions. You had monetary policy looking at the macro economy. Who was looking at the systemic risks in the financial markets? So what my colleague at the Bank of England, Paul Tucker, calls underlap. There was something missing there. And that missing tool was seen to be macroprudential regulation. This was a point that Chairman Bernanke made in a couple of speeches, probably in 2008, 2009, that we needed to supplement the micro and the monetary with this macroprudential regulatory structure. So let me come to a slightly fuller definition of what that is, and I'm using definition actually from the Financial Stability Board, which is an international organization that coordinates regulation supervision across many countries. So I've altered the words a little bit, and it'll go back to what I said at the beginning, at least the first part. Macroprudential Regulation uses prudential tools, so the microprudential stuff, the capital liquidity type tools, to limit systemic risk, reducing the incidence of disruption to the provision of financial services that can have serious consequences for the economy. So you want the financial system to be taking deposits, making safe a variety of assets available to the public in which they can save, and you don't want that disrupted or people to come to doubt that what they have a safe asset they can invest in, and you want them making loans, providing payment services and providing credit services on a continuous basis. And our modern market economies are built on that system continuing to run. So macroprudential regulation is trying to make sure that the disruptions, reducing the incidence of disruptions to that provision of financial services. There are two aspects that people talk about in macroprudential regulation. One aspect you can call the time series aspect, and that's the one that I've spent some time talking about already. That is damping the pro-cyclicality of the financial system, the buildup of imbalances on the upside, and then hopefully if you build up the resilience of the system while you're going up, then you can allow the capital and liquidity to be drawn down on the downside. So building defenses that could speed the stabilization of downswings in credit and their effect on the economy. So build it up in the good times, try and encourage the financial system not to cut off lending in the bad times, because it is more resilient and because the regulators can pull back and say, with safety, we can let you deploy some of your capital because you've built it up already. And that hopefully, as I noted before, would not only make the system more resilient and not have the kind of feedback effects we saw in the crisis where one institution goes out of business and that puts another institution out of business and the whole credit cycle is disrupted, but also might damp that cycle itself, might damp some of the asset prices. A good example of this in the new regulations is the countercyclical capital buffer in the Basel III regulation. So that can be between 0 and 2.5%. And it's supposed to be built up in good times and allowed to be drawn down in bad times. The second kind of macroprudential regulation people call cross-section regulation, and that refers back to the kinds of things I was talking about where you had interdependencies and linkages in the system that could be sources of contagion and spillover. When one went, if AIG had gone, a lot of other institutions would have gone too, those insurance companies, that sort of thing. But there's also the issue, not only the interlinkages and interdependencies that are not sometimes very obvious when you're just looking at the system, but also the effect of everybody leaning in the same direction at the same time. So everybody starts making mortgages at the same time. They have common risks. So looking at each individual one, you might think no big deal. But when everybody's doing the same thing and everybody draws back, then you've got a problem. An example of, two examples of the way that the regulators have tried to meet this macroprudential challenge is one is the so-called SIFI surcharge in Basel III and in Dodd-Frank. That is the extra capital that these large, interconnected, systemically important institutions have to hold because they are so important to the system, they have to be extra safe. And that's part of Dodd-Frank and part of the Basel III Accord. And I think the second example of trying to simplify interdependencies, make them more transparent, and look at it as what people are doing with the derivatives trade. So the idea is trying to force derivatives trading through central counterparties, extent that it can be. There are enough similarities in the derivatives that they can be cleared safely that way. So you force the trading through a central counterparty instead of just pairwise over the counter. And A, you get a lot of data so people can see. B, you can do a lot of netting. And then C, you can see everybody has counterparty is the central counterparty, and presumably the authorities can make sure that central counterparty is safe. Whereas if you have lots and lots of different counterparties. It's very hard to make sure that's safe. And the third aspect you often hear about in this kind of has a cross-section flavor to it is the so-called Volcker Rule, Vickers, break up the big banks. So are these banks so important, so interconnected, that we need to take some of their activities out of them to make them safer and to make the system safer? The Volcker Rule takes proprietary trading and investments in private equity and hedge funds beyond a certain small level out of the banks. Now, that's motivated in part by making the system safer. I think even more, if you talk to Paul Volcker sitting here, he'd say it's even more. I just don't think the safety net, the deposit insurance access to the Federal Reserve that stands behind the banks ought to stand behind these kinds of trading as well. The Vickers effort, the Independent Commission on Banking, ICB in the UK, suggestion was to keep the bank holding company together, but make sure that the investment bank was separate from the retail bank. That's a little bit of an oversimplification, and in fact, they haven't really clarified where that line should be drawn. But if you do that, the thought was that, number one, you can make that retail bank that provides services, payment services to everybody, and loans to households and probably smaller businesses, and deposits to these folks. You can make them super safe because they're not in international competition with other banks. So if you want to require more capital from them, you don't put them at a disadvantage. And then it makes it easier to deal with a bank when it gets in trouble. If you have two pieces rather than one piece that's sitting together, then maybe you can resolve these banks in a less disruptive way, and one that does less to protect the creditors than if they were a big bank. So Vickers is breaking up the banks as well. What are some of the challenges? I can see I'm running out of time. So let me just list some challenges. We can come back to them in the Q's and A's. I think one big challenge is identification of systemic risks, both the time series and the cross-section. In the U.S., Dodd-Frank created something called the OFR, Office of Financial Research, in the Treasury Department, and it's supposed to collect data and analyze it to look at some of these interactions and interdependencies, as well as the time series kinds of things that were so hard to spot before the last crisis. And they are in the process of getting up and running. In the UK, the Bank of England, the governor sends to the Parliament a short list of indicators that the bank is looking at: the amount of credit in the economy, the leverage in the banking system, and a few others, trying to look for early signs that something's going wrong. The counter-cyclical capital buffer in Basel III is supposed to be keyed to a particular indicator. It's the ratio of credit to GDP. So if it looks like the ratio of credit per dollar of GDP is deviating from its previous trend, that's probably a signal that there's too much credit being granted, and you maybe ought to raise the countercyclical capital buffer, and then when it goes the other way, maybe you ought to release the countercyclical capital buffer. So there are a lot of efforts underway to try and see if we could have seen this crisis coming earlier and early enough to stop it, or at least to damp it down and not have it cause as much damage as it did. None of this is easy. I don't think anybody's come up with some magic small set of indicators that every time someone suggests something, there are 3 publications to say, but it didn't work here, it didn't work there, and it won't work in the future in some way. So this is a real challenge. If you're going to run macroprudential policy, you got to have concrete things you can point to say, this is why I'm increasing the capital buffers to take, and these are the indicators I'm looking at to release those capital buffers. So there's a lot of work being done on that. I think a second challenge is what tools should be used, which of those macroprudential tools should be used in a counter-cyclical way. Capital is the one I've referred to repeatedly. So there's explicitly this counter-cyclical capital buffer at the Bank of England, at this Financial Policy Committee. We obviously think that's one thing we'll be looking at. But another thing we thought we'd be looking at are the sectoral capital requirements. So if we see a problem developing in the real estate market in the UK, why don't we require the banks to hold a little extra capital against the real estate market? And I think this law creating the committee this is a great system in the UK. They set up the committee and a year and a half later they passed the law. But can you imagine that happening here? So they're now talking about the law that's going to validate what we're doing. And I think the government put out a discussion paper yesterday or the day before that suggested that was fine with them, those two things I talked about. And then the third thing is the leverage ratio, whether we should be able to move that up and down countercyclically. And they said maybe in 2018 when it comes into effect. Other tools that people have talked about are things like margin requirements, not as I was talking about in the equity market, but what about in some of these lending markets, the RP market, for example, these financial markets. One of the things that happened in the crisis was the margining became very pro-cyclical. So as asset prices headed down, of course, the lenders wanted more collateral, right? And as they wanted more collateral, that meant there was less, that was put more pressure, liquidity pressure on the institutions to come up with the collateral or come up with the cash. So the thought here is that at least maybe you could move towards a margining system that the margins were higher in the good times than they are now and lower in the bad times. So sort of through the cycle types of margining. And liquidity, obviously, is another area that people are looking at. Can the amount of liquid assets that the banks have to hold, should that go up in the good times and then be released in the bad times? I think so data and identification was one problem, tools were another one, a third one is pulling the trigger. So when do you say, let's talk about two things, in the good times and the bad times. In the good times, you have to ask the banks to hold more capital. You have to tell them, your loan losses are really low, and you're very profitable, and you're well capitalized, but we want you to hold more. And we want you to hold more, not because we're worried about what might happen to you tomorrow, but because there's a tail risk out there. There's a small risk of a major conflagration, a tsunami, whatever the metaphor is we want to use here, earthquake, whatever that might be coming down the road. And we want you to disadvantage your shareholders to protect the system from the possibility that there's an earthquake sometime in the next, a financial earthquake sometime in the next 10 or 20 years. It's a very logical thing to do, and God knows I wish someone had done it, 10 years ago. But it's not going to be easy politically to do that. It's going to be a challenge. It turns out, but everybody understands that and understands the issues. It'll be resisted by industry and the people in the Congress that depend on the industry. Releasing in the downturn is also very, very hard and an issue that people are coping with today. So there are two objectives for this macroprudential regulation. One is to build the resilience and make sure the system is resilient against future shocks, and the other is to try and smooth the credit cycle. Well, think about the current situation in the United Kingdom. Banks are building capital slowly, but from a very low base. The base that got way too low before the cycle began. And they are facing a potential tsunami, choose your metaphor, coming across the channel from the euro area if that area gets in worse trouble. So you want them to build more resilience. And a number of UK banks, of course, have exposures in Ireland and Spain. I mean, UK is an entry port for international banks, global banks, into the continent as well. At the same time, they're facing a credit crunch in the United Kingdom. And the credit crunch, small and SMEs, small and medium enterprises, comes in part because everybody's looking at the UK banks and sees they're at risk and their funding costs are somewhat higher than they otherwise would be. The banks themselves are being cautious. Two of them are owned by the government. Lloyd's are majorly owned by the government, Lloyd's and RBS, and they're trying to shrink and figure out what their future business looks like. And this is constraining the UK economy. So trying to do two things at the same time. You want to build the resilience. We want you to have more capital. The banks say that's expensive, but we want you to continue lending to the UK economy. At our last meeting, we actually had one on Friday, and I can't talk about that one until the announcement is out, but the meeting in June, we approached that in two ways. We said, on the liquidity side, so the FSA has liquidity requirements. The supervisor in the UK has liquidity requirements for the banks, and we said, you ought to remind. And the banks are holding more than their requirements. There's a cushion, a buffer on a buffer, and we said a couple things to the FSA. Number one, you ought to remind them that in stress times, you're allowed to draw down that buffer. Right? That's what it's there for. It's there to keep you making loans even when times are tough. And number two, remember you got a central bank sitting back here, the Bank of England, that has a discount window that can provide liquidity insurance. The whole point of the discount window is to provide liquidity insurance to the banking system. And furthermore, the Bank of England was increasing the accessibility of that discount window, trying to encourage banks to use it. So we think you, the FSA, the macroprudential regulators, said to the microprudential regulators, we understand why you want these guys to have a lot of liquidity. If you can't tell what's happening, it's a tough world out there, but we think the country, the UK, will be better off if they release some of this liquidity and make loans. And taking account of the central bank sitting there is a good way of doing that. So the FSA agreed to do that, but it was a interesting conversation, and the FSA wasn't reticent at all, but you had to think about what you were doing, releasing that liquidity. At the same time, we told the banks we wanted them to continue building capital because we wanted them resilient against some bad stuff that might happen. I think I will skip a few things. I mean, another issue, and I won't go into it, is the governance and institutional structure. Central banks tend to get involved in macroprudential regulation. I think it's a great idea. Central banks know about the macroeconomy and the financial markets, but it complicates to some extent the accountability and who's doing this. There are interactions with monetary policy. Both the macroprudential regulators and the monetary policy makers are looking at GDP and credit and what's happening there. I think most of the time they'll all be going in the same direction. So things are building up, and the monetary policy makers will be worried that inflation will come, so they'll be tightening. The macro regulators will be worried that banks are getting overextended, so they'll be tightening, and they'll just take account of each other, and it won't be such a big deal. But there are times when, like right now, when the buffers aren't there, the monetary authorities are trying to stimulate the economy, and they'll worry that the macro and microprudential authorities are holding it back. In the U.S., there was a lot of efforts to talk to the microprudential authorities, supervisors, make sure they weren't discouraging banks from making good loans, and lots of guidelines put out on that. In the UK, this is a public thing, the Monetary Policy Committee said to the Financial Policy Committee, are you sure your regulations aren't stopping our stimulus from having its desired effect? We are telling the Bank of England to buy a bunch of gilts, a bunch of securities to put reserves in the system, and you're telling the banks they got to hold more reserves. So would you please make sure you're not working such at cross purposes with us? And that's one of the things that led to this agreement with the Financial Services Authority, the FSA, to release those liquidity buffers. So we weren't working quite at cross purposes with them. There's the issue of migration to less regulated markets. You start regulating some parts of the market very tightly, and you'll find the activity regulates to other markets. So you got to be constantly on the prowl at the perimeter of regulation. And then finally, there's the international multilateral dimensions of all this. We live in a world of global capital markets, global financial institutions. That means one area, problems in the U.S. subprime market can have effects on economic activity in Germany and the UK and other places, in part because their banks participated in this market. So there are spillovers. It also means, we have an interest in, or right now, think about the U.S. and Europe, so problems in the European banking system and Euro area more generally are spilling over to the U.S. economy. So we have an interest in making sure they do things right. I think there are also need for cooperation to make sure the steps you take are effective. So let's say the U.S. would raise its countercyclical capital buffer because it thought too much credit was being extended in the U.S. It doesn't do much good if people just go to banks somewhere else and do the same borrowing for houses or automobiles or whatever. So there is cooperation there. So if one country raises its countercyclical capital buffer, other countries need to honor that for lending in that country. But this is required, no one's hasn't been, I don't think, put into effect yet, but this is requiring a degree of cooperation to make the macroprudential regulation work well. And there are, in particular, the Financial Stability Board, the FSB, is a organization. It used to be called the Financial Stability Forum, and it really was just a forum where people talked to each other at great length. The conversations were good, and sometimes actions came, but now that's by the G20 strengthened the hand of the changed the name to Financial Stability Board, gave it more things to do, and it's led the international efforts to coordinate and make sure that standards are upheld around the world. So it doesn't, I think it's important to us that other countries are having high standards, are important to every country, and the Financial Stability Board is leading reviews of other countries and the U.S. to make sure everybody knows everybody's working together on the same kind of thing. Let me stop there. That was more like 45 than 30, and take questions after I have a drink of water.
Well, I guess I'll just start out with one quick question, and this might be slightly different from the tone of the rest of the questions, but we're all students and sort of deciding on career paths, and you've been working for the Fed for 40 years, worked there for 40 years. It seems to me like one of the challenges is attracting people to work in regulation. And is that, do you think that's a challenge? And if so, how is that challenge being addressed?
I think it is a challenge, and it's not only attracting but retaining. So I think there's been a long history of people working in the regulators and then going out into the industry. And I don't think that's bad, because some people would say, well, when they're inside the regulators, they're looking at their next job and they're not being as diligent as they otherwise could be, but that's not my experience at all. My experience is sometimes the toughest, most diligent regulators are the ones that are in greatest demand outside because they know how the system works and they can bring that expertise. And it's really, I've talked to some of my colleagues, particularly some that we went through the crisis with, who are now out in the private sector, and they say one of their really important jobs is to say, well, you just got a letter from your Reserve Bank president. You can't ignore that. They really mean what they're saying, and you're trying to find some way. You've hired a lawyer to figure out some way around this, but they're going to figure you out, and you've got to do the following things. So this flow facilitates, I think, communication. It's not a bad thing. But it also means that the regulators and the supervisors may not have the same experienced cadre of people. So I worry about that. Compensation is part of the problem. I think, I did spend 40 years in the Federal Reserve System. So to me, I was getting compensation in the form of satisfaction with my job, knowing that when I got up in the morning and went to work, that how I did my job actually had an effect on the rest of the world. Even when I was a lowly staff member, the information I might be feeding to the policymakers would affect how they thought about it, and that was very scary but very gratifying. So I think there are a lot of non-pecuniary returns to working at the Federal Reserve or the SEC or wherever, but it's hard, particularly in the good times, to compete with the huge salaries that are being paid, especially in the financial sector. So I do worry about the experiential issue. I was really happy to hear at least two, and you said two more people from here are going to the New York Fed. That's great. That's terrific. Yes?
I wondered if you might be able to speak to the proposals of universal banking system within Europe and its impact on the UK, particularly the banking.
Well, so Europe has a universal banking system. There are very few separate investment banks. It's all several big banks. And furthermore, not all of them, but none of them tend to be identified as national champions, so particularly in France, but in other places as well. So they have kind of a semi-backing by the sovereign. Problems over there, and to considerable, so certainly that's resented by U.S. banks who feel like the European banks get extra breaks on capital, et cetera. And I know Jamie Dimon called Basel III said it was against American banks. What was un-American? So what was his particular problem?
I don't remember the specific, but it's the way it applied to American bank. The way it applied disadvantaged American bank relative to the European bank. Yeah.
But the European banks feel like they're being disadvantaged too. It doesn't matter who you talk to, right? So I think the important point here is the international coordination and cooperation. So everybody signs on to this Basel III 2.5 and 3, the toughening of these Basel Accords. Everybody gets brought up to the same level. Yes, certain countries have characteristics about their banks that make them a little different than others, but it is it's critical to global financial stability, UK, US, wherever, that these big banks overseas also be stable.
If you don't mind me sort of honing my question a bit, so I suppose my question is more pertaining to the central regulation of the system by the ECB and how that might influence macroprudential regulation.
So I'm not sure. That's a different point and a good one. I don't know enough about the most recent proposals that came out late last week for the ECB, and particularly there's a your EBA, European Banking Authority, and what authorities they have and how that will intersect with the Bank of England. But there's tension between the EU and those rules, which would cover UK banks and UK regulatory authorities and the UK. And in particular, the rules proposed in Europe for transparency, for data gathering, for capital, for liquidity, are proposed as what Barnier, the Commissioner of Finance, or whatever he is, the big high poobah in Europe on financial stuff, calls maximum harmonization. So he's saying not only do these things provide floors, they provide ceilings as well. And you cannot ask your banks to have more capital than these levels. The chancellor, my chancellor, fought back hard against this and got some relief on real estate loans. So I told you sectoral capital requirements are one of the things that the Bank of England was looking at, or the Financial Policy Committee was looking at. And they got some relief on that. So we can raise sectoral capital requirements on some kinds of real estate lending. I think there was another thing too, but it was limited. So there is some tension, as I say, between the desire of the people in Brussels to have everything the same everywhere and the desire of the individual countries to make their own banking systems safer. To me, the issue is the disconnect between the supervision, if it came from Brussels, and the fiscal responsibility. So it's the UK taxpayers that own 42% of Lloyd's and 83% of RBS. It's the UK taxpayers that would be asked to support those banks or other banks if they got into trouble and it was decided they were too big to fail. And it seems to me that having somebody in Brussels tell you you can't make the system safer than they tell you, even though they're not, it's not the whole European Union that's going to pay the bill, it's going to be the individual countries. So there have been some compromises to give, but it's still a point of tension. And though I don't know enough about the most recent most recent proposal by the Commission, I did read that the UK, Sweden, some of these other countries that aren't part of the EU had objected to some aspects of it. So I suspect there were further constraints and further intrusion into national space of these multilateral regulators like the EBA. Yes.
I'm David Finson. I'm interning at the board.
Oh, good.
Supervision.
Good. Great. Excellent.
So I want to ask a personal question. Okay. So could you talk a little bit about what it was like the weekend before Lehman declared bankruptcy, and did you and Mr. Bernanke and the rest of the board pull all-nighters, and what was it high stress level? Can you just talk a little bit about that experience?
We can do this briefly. I think it was very high stress, but I would say, and if they weren't all-nighters, but they were short-nighters, that's for sure. Calls at 2 in the morning and all that kind of thing, 5 in the morning. It was very difficult. I mean, first of all, I was in Washington while the action was in New York, and we were getting, with the chairman in Washington, we were getting lots of periodic calls, which ebbed and flowed in terms of the degree of optimism and pessimism as to whether a deal could be put together. At the same time, we knew, I mean, Secretary Paulson and the chairman and Geithner went into that weekend saying there are 3 things we need to deal with here. We need to deal with Lehman, AIG, and Merrill. So Merrill got taken off the table because Bank of America bought it. Bank of America's regret a few months later. but they bought, at the time, it was taken off the table. That meant Bank of America wasn't available to buy Lehman. So there were a lot of interest. And at the same time, there were issues about AIG, and you knew that. So actually spent some time working on AIG, talking to those people that weekend, as well as keeping in touch. I would say in some sense, the higher stress, the worst situations were the following week, when Lehman went, and then Reserve Primary Fund broke the buck, and you had a run on the money market funds, and a collapse of the commercial paper market. And that meant that lots of companies couldn't fund themselves, that this run was spreading to other places, and those were close to all-nighters trying to figure out what to do, how to stop it, what the legal authorities' capabilities were of the Federal Reserve and the Treasury, which ended up using the Exchange Stabilization Fund to stop the run on the money market funds. So it was very high stress. And the AIG Chairman Bernanke has been very clear. He said that was the worst decision he had to make. He said he was very angry, and he was. I can testify. He did not want to do that loan. I mean, here was a company that hadn't been regulated by anybody. I mean, at least in Bear Stearns, you could say it had been regulated by SEC, not very well, et cetera, et cetera. It was a regulated entity. AIG was regulated by OTS because it was a thrift holding company, but OTS didn't have a clue what was going on in there, and the various state authorities who all had a piece of the elephant, right? But they had no idea what the whole elephant looked like. And no, I mean, I stressed in my presentation the interconnections of AIG with the other pieces of the financial system. But I would say what was on my mind at the time on that Tuesday when we ended up making a loan to AIG was not only these interconnections, but the fact that AIG was the biggest insurance company in the country, if not the world. It had played a huge role in lots of 401ks, retirement funds, and to me it was, what this would do to lots of average Americans if their life insurance, property casualty insurance, or 401ks looked like they were at risk, played an equal role to what it would do to Goldman Sachs and all the other people that were counterparties of AIG. So I didn't think we had much choice. Once Lehman went and the markets were collapsing, then no one, the private sector didn't want to step in with AIG because everybody was running for their cave, right? They didn't want to, their principal responsibility was to stay alive. So although they'd been sniffing around AIG over the weekend, and it was a private equity guy, what's his name, Chris Flowers, sitting in there, and but everybody, as soon as the markets imploded, everybody said, no, I'm not going to touch this thing. I didn't think we had much choice but to go in, but it was a difficult decision, and the chairman was not a happy camper.
So, as a follow-up question, were there any dissenting voices on the board who was on that other side of the argument saying, let it fail?
Not really. But I would also say, here's something to think about a little bit. It's hard to have a really good discussion under those circumstances and under government in the sunshine. So under government in the sunshine, every time four governors, there's seven members of the Board of Governors get together, it's a board meeting. I mean, you can have a social event, but if you discuss policy, discuss issues, it's a board meeting. You have to announce to the public you're having a board meeting. And then you have to have a specific reason for closing it. So surely we could have closed such a meeting. That wouldn't have been a problem. But it does discourage communal cooperative policy making. And it tends to, I think it tends to put more power in the hands of the chairman, because the chairman can't consult the whole committee. He has to do it himself or with a few trusted lieutenants. I think this is true at other agencies as well, SEC, for example, my experience over the years. So government in sunshine is a terrible law in my mind. It undermines the board or commission character of these agencies, however well intended it would be. And the other point is things happen really, really fast. And by the time you get to the decision point, it's almost a fait accompli. There aren't that many choices you can make. This was a thing that rankled some members of the Federal Reserve out in the reserve banks and at the board, that they felt like every Sunday night they were being called to a conference call and told there was some new deal had been worked out, and new facility being opened, and opportunities for true consultation were very, very, very limited. Bernanke once said he thought he was going to title his book "Before Asia Opens," which is what we were told we had to get the decision done before Asia opened on Monday morning or Sunday night our time. Yes?
I always see two buzzwords whenever firms fail, repos and rehypothecation. Am I saying it right?
Rehypothecation, right.
Can you explain their role in the financial crisis and the future of their regulation?
Yeah, I'm not as technically adept as I should be, but repos, of course, are lending against securities. So technically you purchase the security with, if I'm the lender, I purchase the security in the promise, and you say I lend you money, I purchase security from you and you promise to buy it back the next day. That would be an overnight repo. And it's the problem is, how much extra collateral do I get from you against that loan? What happens if that price of the collateral drops overnight because of a problem? So when this was a source of funding, so there are two issues. One is you're funding mortgages. You're making mortgages and you're funding them with overnight loans from me. And the second related issue is when the price of those mortgages falls because, say, they're mortgage-backed security, a collateralized mortgage obligation of some sort, then, of course, I want more collateral from you, or I'm going to give you less cash, right? So you need to come up with more cash somewhere else. And that, going into the crisis, before Bear Stearns, I would say, people thought secured lending or secured borrowing, like the borrowing you did from me against securities, was good. I mean, didn't have to worry about it. And I think the SEC's rules didn't require sort of a liquidity backstop for that types of secured lending. Is it? I don't know. And then all of a sudden what we found out in Bear Stearns was that lending, even though it was backed by treasuries, agencies, really sometimes good collateral, but sometimes not so good collateral, could dry up as a source of funding. So it became a propagator of the crisis. And the New York Fed has worked very hard with the financial markets to try and reform that market to make it safer, with only limited success. And one of the things they've tried to do is extend those things. So you were borrowing from me overnight, you might come back the next day and borrow overnight, and third or fourth day. So every day you repay, your bank account goes negative, then I give you the money that night. So one of the things people said was, what if you think you're going to have this security for 5 days, just borrow for 5 days, term out the loans, and that will prevent some of this churning. So some of that's happening, I think, but more fundamental reform and concerns about what would happen if you can't repay, how that all gets worked out, that really hasn't been worked out very well. The rehypothecation is, if I have your securities, let's say, I think, and maybe you can do this better than I can, but I lend out the securities to somebody who, say, wants to take a short in them, and they pay me back later, or they give me the cash for those securities, I invest the securities. Meanwhile, there's a chain of rehypothecation. They might lend them out to someone else, and that can get very complicated, and once again, it has to do with margins and safety. And so securities lending, which I think is part of the rehypothecation issue, was something that AIG was very involved in. So they were sitting on a lot of securities in their insurance companies. They thought they could lend them out and make a little extra on it, and that turned out to be a liquidity strain on them, because when they got downgraded, all of a sudden the people who are lending them money and taking the securities wanted more collateral, et cetera. So people are looking at that. This whole the difficulty of looking through these chains and knowing who owes what to whom in the end makes it hard to police, for the private sector or the regulators, to police those markets. Is that fair? Yes.
I guess maybe on a related note, you've explained how Macroprudential Regulation will require institutions to have higher capital requirements and
under some circumstances, right?
Under some circumstances, and break them up to have better aligned incentives in this
Maybe.
But how could you maybe expand on how they'll address the risks that come from securitization and the kind of improper ratings that played a part in the crisis? I'm not quite sure how exactly they'll.
Okay, so I think there are a couple things going on, and maybe you can help me out if I miss some. One of them is they're being addressed on several dimensions. Number one is for securitizations, particularly for complex securitizations, when the bank takes it off their balance sheet, they'll still be required to hold some capital against it, and even though it's off the balance sheet. So capital against off-balance sheet types of risk is being increased. Secondly, unless, and I think these rules are still being written, unless the mortgages are kind of look very safe, plain vanilla, you can't sell 100%. You've got to retain 5%, I think, of the security. So you have to have skin in the game. So the thought is that you wouldn't, say you were making a bunch of subprime loans, you'd be a lot more careful about those loans and how they were securitized and who held them if you had to hold some of them yourself. So you had some skin in the game. Those are at least two ways this is being.
I think you mentioned the rating agencies, and I'd be interested in your reaction to this. Everyone looked at the rating agencies and said, these guys really played a role in the financial meltdown and really let the ball drop. We need to do a lot to fix that. And many proposals were made about how that would be done. But the end result in the Dodd-Frank statute was to strengthen and beef up the SEC's oversight of the rating agencies. But by and large, I think the observers have said they got off pretty easily, given the role that they played. And part of that is because it's very difficult to regulate an activity like that. And part of it is that they were very persuasive in defending themselves against efforts to do it. But that's all that came from that aspect that you mentioned.
Well, the other part of that, Dodd-Frank said to the regulators, you can't rely on the credit rating agencies when you're putting your capital requirements together. So before they said there's a certain amount of capital against the AAA, more capital against the single A, double B, that kind of thing. And that's forced, and I don't quite know where this process is, that has forced the regulators, the supervisors, to come up with substitutes for these credit ratings in their regulations. And that's been an extremely difficult process. And I don't know where the process is, to tell the truth.
Do you feel that the Fed has some sort of obligation to the U.S. public to reveal their sort of internal
ratings of these things? I don't know. It's a good question. I don't. And I don't know where the Fed or the other regulators are on this thing. Just one expansion about how difficult this is. The Federal Reserve put into place a lending facility called the TALF, and don't ask me what those initials stand for, but I know what it did, and it lent to people who were buying securitized assets. And we did equipment loans, student loans, automobile loans, all kinds of category by category. And we tried not to rely on the credit rating agencies because the credit rating depended on, that was an important input into how much money the private sector had to put up in terms of the margin when they got the loans. It was very hard for Federal Reserve staff, and you had New York Fed and board staff working really hard on this to come up with their own independent views of the riskiness of these assets and how that riskiness would change with changing economic conditions. So coming up with a substitute is not easy. I think there are some circumstances in which it would be good to be transparent about this. It could be a powerful tool in the regulators' toolkit if they reveal that they thought certain loans were. But on the other hand is putting them in that position feels like allocating credit and picking and choosing borrowers. It's pretty uncomfortable. Yeah.
So you talked about the importance of these international gatherings to prevent what I would call regulatory arbitrage.
Yep.
Right?
Yep.
So I was curious about your confidence in their ability to remain effective or relevant as the memory of 2008 recedes and as domestic pressures build and the diversity of kinds of economies that are participating in the financial system.
Well, I think it's an issue. I think you pointed to an important point, and already people have noticed that although there was a huge amount of cooperation, coordination in the middle of the crisis, it's much harder coming out. You have national laws involved. But I think that at least for the current generation of regulators, it will be a long time before the memory fades. And an important role the Financial Stability Board plays is to keep the pressure on. And they've done a great job, first under Mario Draghi, now under Mark Carney, of keeping a lot of momentum going in a lot of different areas. And to some extent, the international pressure is designed to counteract any growing complacency or desire to protect national interests relative to global issues. But I don't deny that what you're talking about is a risk. If it's not a risk this year, next year, it could be a risk in 10 years. Everybody's, everything's fine. What are you worried about? These banks are profitable, well capitalized. It's a problem. Complacency is a problem. Yes.
Along that same line, how do you reconcile the macroprudential tools and policies that you're talking about to fend against systemic risk? How do you reconcile the scope of what is systemic risk, whether it's domestic, whether it's regional, whether it's global, and that should make it even more harder for political reasons?
So I think people generally think of it on a national or international basis, which obviously is bigger than the nation state. So I think for the most part, I'm trying to think of this, people haven't said, well, gee, there's a housing bubble in Nevada, but not in any other place in the country. So I think that's not a threat to the financial stability of the United States. And in fact, that was one of the issues, wasn't it, leading up to the crisis? People said, including Alan Greenspan said, that he characterized housing markets as frothy, by which he meant that there are little bubbles all over the place, but no big bubble. He was wrong, but I think it would be difficult, to have the national authorities go in and say the southwestern United States banks have to hold more capital than northeastern United States banks. And it wouldn't be effective unless you forbid the people from Northeast from going to the Southwest or something like that. So I think the regions within a country, I think the national authorities have to look at national developments, whether they're monetary policy or financial stability, and
in the case of somewhere like the UK, because in terms of regional, I meant regional economies, like you have a personal or a domestic case, which is whatever your economic situation at home is, and sometimes it is so linked to the global case or even regional in terms of APU.
Right.
But if it isn't, then how do you sell that? How do you sell the fact that okay, pro-cyclicality now, let's say that's not their case, but they're growing, but they use such a danger because they're so closely linked. And how do you make the decision of do I impose policies that are domestic or mainly focus on the domestic cyclicality or
very hard, and it's exactly what's happening now. So in terms of individual countries telling their banks to make themselves safe and against the European situation. And I think there's been, and Mario Draghi's pointed to this and others as well, a kind of a fragmentation of the banking and capital markets in Europe. When a year ago or so, when the European Banking Authority said you should have 7% or 9%, I guess, capital by a certain date, the way a number of European banks reached that goal was to draw back from to de-lever in the denominator, to reduce the denominator instead of increasing the numerator, the capital ratios. So it's extremely difficult and extremely delicate. You don't want to do something. So think about the UK authorities. You want to make sure UK banks are safe. You don't really want them doing something that exacerbates the problems across the channel by withdrawing from lending. It's a very, very hard thing. So it's just a personal experience. I was interviewed by the Financial Times a week ago, and this was, I guess, in the UK edition, so you probably didn't see it, but the reporter was trying to get me to say that we wanted UK banks to withdraw from lending in Europe in favor of lending in the UK. And I was trying to dance around that because it is a bit of a schizophrenic kind of thing, right? So I said it's really important that they lend in the United Kingdom. This is their home, and it's in their business interest to establish, to be good lenders, and we want them to manage their risk in outside, and they have to do a better job of managing their risk. But the headline on this thing, so I didn't say what she wanted me to say, but the headline was, Bank of England's cone says banks should stop lending in Europe. Was a lesson. Okay, you've had your hand up.
I had actually a very specific question. So the SEC recently, last month, decided not to pursue any additional reform of the money market mutual funds. This is an interesting issue because the FSOC now has the opportunity to potentially take a supervisory view of the SEC in a way and give the Federal Reserve some authority over this. Do you think this is a Rorschach test for the FSOC? And if you were on the FSOC, which position would you take on this?
So I worry about the start with the substance. I worry about the money funds. I don't think the SEC has done enough, and I would have, at a minimum, make to market. Forget the dollar.
So no NAV.
No fixed NAV. And because I think the fixed NAV attracts people who want it to be more like a deposit, and it also is an incentive to run. If you're the first person out the door, you'll get your buck. If you're not, you'll get 95, 90, 85 cents on the dollar. So it gives the wrong incentives, the wrong signal. I don't see why those should be the only mutual funds in the world who don't mark to, or in the U.S. who don't mark to market. That would be helpful. They had other suggestions about capital and whatnot, but I don't understand why they couldn't come at least to a partial thing. The role of the FSOC, I think, is tricky. They can certainly make recommendations to the SEC, and I'd be surprised if they didn't do that, and I'm not sure why they didn't do it before. before the vote happened, rather the lack of vote, before the lack of action was clear. In order to affect, as I understand it, in order to really do something other than make a recommendation to the SEC, they have to declare some mutual funds systemically important. I think that's tricky because if I think back to the post-Lehman, it was a small mutual fund that broke the buck, that broke the market. It wasn't one of the big giants. So I think it's harder to argue that 2 or 3 of the largest money market funds are systemically important and the rest aren't. So I think, as I understand what FSOC's tools are, they can't declare the industry to be systemically important. They can only declare firms. And I think they're in a very tough position. And I hope that after the election season, people come back, whoever is elected president, I don't care, on this particular thing, they rethink this and do something to make those money funds a little safer. It's an issue elsewhere, too. The money funds have a lot of their investments are in European banks, defining UK to be part of Europe for this particular purpose. And if there were a run on the money funds, there would be the European banks would be at risk as well. So it's not just a U.S. problem. It's a nice example of these global problems.
We have time for maybe one more question.
Okay, go ahead. Yeah.
We all know that Basel III set the tone for macroprudential approach, but at the same time it also set the same capital requirement, liquidity requirement for both developed markets and emerging markets. I'm just wondering, consider the different situation, economic and fiscal situation in developing countries and developed countries. Do you think that it would rule for the capital requirements, also applicable to emerging markets as well, and would it cause potential problems?
Yeah, I don't have a good detailed knowledge of that. I think, and the emerging markets, when I was around, were complaining about Basel II as well. But I guess my going in thought would be, if you need to be safe, you need to be safe. And it doesn't matter where you're located or what kind of business you're doing, you need enough capital to cover the risks. And I think some of these emerging markets, China is a good example, if there's financial problems over there, they'll spill over to the rest of the global economy. So I would hope, it's more difficult for smaller banks, whether they're in the U.S. or in emerging markets, because they don't have access to capital markets. Harder to generate external capital, but they can still produce. I would hope that the movement would be, anyhow, even if it's not all the way there, towards everybody adhering to Basel III. Recognize that Basel III requires more capital for the very largest banks, which are primarily in developed countries.
On that note, thank you so much. Can we give them a hand?
Thank you for lunch.
Thank you. And we have an internship panel on Monday that Eric's putting together, so join us if you can.